Mutual Fund Show. I'm Niraj Shah. This is the Diwali special, and with just a few days left for the big day, it always helps on such an occasion to recount what's happened in the Samvat or the year 12 months gone by, and what are the learnings from this that some of the biggest names in the industry have for themselves, which they'll talk to us about, and hopefully we can take it from there to imbibe those learnings in our portfolios to have a better Diwali the next time. Our guests today, Radhika Gupta and Kalpen Parekh. They need no introduction. Both of you, thank you so much for joining in.
Thank you. Thanks for inviting me.
All right, Radhika, can I... Yeah, thank you. Radhika, can I start with you first? What is the key learning from the Samvat gone by?
I think that the old learnings work, Niraj. Truly that the old learnings work. I think the old mantra around asset allocation, sticking to your asset allocation, around asset classes finally reverting to means, I think that is the real learning from this Samvat. I honestly feel that we don't need to discover new learnings every year. We honestly need to revisit old learnings and make sure we truly learn them.
Okay, interesting thought. Kalpen, for you, and while what Radhika said might be true, what's your key learning been? Is it different from the previous ones?
So Niraj, my key learning is that coming on your show every Diwali for last many years is a certainty, is reasonably predictable, but markets remain unpredictable. And that lesson gets reinforced every year. I think the last year again highlighted that no one knows. Almost nobody knows the future. Everyone has opinions and views, but more often the future is very different than what is discussed. So whether it is central bankers, policymakers, money managers like us, politicians, everyone had views on many things, and what played out was very different. And that makes me conclude again and again that nobody knows the future. All we need to do is to ask this question, that how much of the uncertainty is in the price, and is there margin of safety or not? And if yes, then build your portfolios accordingly. If no, then reconsider risk and don't bet your hard-earned money, or I lesson to myself is don't bet my hard-earned money on trying to have very interesting long-term forecasts.
Okay, and well, the fourth question is something where we'll lean on this for a bit, but let me go in the order that I thought of. I'll ask you guys. So Kalpen, this one is to you first. While you are right that nobody knows what happens, but sure, the 12 months give you enough time for a surprise. What surprised you the most from an investing or a mutual fund perspective in the last 12 months?
Definitely, if you look at the broad asset classes where we as money managers invest our or your money in, it is equities, bonds, global equities, and gold. Broadly, these four asset classes. And if you look at it, almost the winner in the last 1 year was actually gold. Gold did better than equities. Equities, we are almost flat. Nifty is down 1.5-2% over the last 1 year. Bonds are flat to negative because rates have risen very sharply. That was not so much a surprise because interest rates were so low, and it was a matter of time when would they rise, whether in the next 6 months or next 2 years. But that was bound to happen. Global equities, which was flavor of the last year, actually slowed down. Also not so much a surprise because we were all talking about the fact that it is sitting at a 10-year high. Some point in time, consolidation will happen. I think what surprised was the speed at which central banks changed stance and took away that comfort or the complacency that we are here always to backstop. That changed dramatically, and the speed of rise in policy rates reflecting in bond yields going up was a surprise. The dollar strength much higher than what was expected, and the fact that it continues. And of course, one very big surprise was what happened with Russia and Ukraine, because in many decades now we have not seen a country invading another country and taking almost the world to the brink of war. So those were very unusual outcomes. What was not a surprise was, commodity prices scaling up extensively because coming after a decade of very low investments in, capacities on the energy side, under the labelization of ESG trends and so on and so forth. Mm-hmm. Now, when those stocks have started doing well, there is a new narrative that ESG should be more nuanced and more balanced. So these are some of the points that moved, differently than what I would have expected.
Interesting. Radhika, what surprised you the most?
I think extending from what Kalpen said, the speed of the post-COVID rally and then the quickness with which everything reverted. I think the speed at which things reverted. I would also point out, he mentioned equities, bonds, etc. I would say the private markets really, really surprised me because we saw, and finally, I think private markets and public markets are not delinked from each other. I mean, one of the learnings over the last 2-3 years is really countries, economies, and markets are much more closely linked. What sort of the bubble that happened in private market all the way through some mega listings and the speed at which that turned around because of rates rising the way they did, I think that was a surprise. And that very suddenly changed the sentiment even in listed markets around international investing, around tech IPOs, around new age asset classes like cryptocurrency. So I think the speed of everything, surprised me. And I think one of the learnings is perhaps cycles are also getting shorter. Perhaps market cycles, we've been brought up on a diet of maybe 5, 7, 8-year-old
8
cycles.
years.
I think cycles are getting sharper and a lot more intense.
Yeah, actually, very interesting, right? Nobody would have thought gold would do this. Nobody would have thought that the cycle would reverse and come back so quickly as well. So I think in some sense, those are my two key takeaways from the answers that you gave. In which case, Radhika, can I ask you, because of this key learning or otherwise, has there been a large investment tweak that you would have made to your portfolio? I mean, I know most people would say that you kind of invest for the really long term and therefore budget in most contingencies, but at times, because cycles are shorter and there have been surprises, have you made some tweaks to your investment portfolios?
I would say not significant tweaks. I think the one thing that I do try and do is that when equity is correct, I do try and add to equities, particularly on the mid and small cap side. So whenever there is that correction opportunity, that's something that I look to add. But otherwise, I think it has been status quo. It has been continuing to do SIPs and use dynamic asset allocation funds. And I really think that that has been in such a volatile year. That has probably been the approach that has worked in terms of mental peace, in terms of the fact that nobody can really predict anything. So outside of adding a little bit to equities on the mid and small cap side, and I'm selectively looking at gold and silver as investments.
Interesting. Kalpen, what about you? Have you made some tweaks, considering that you mentioned that gold was the surprise package already in the Samvat gone by, and there has been in a manner of speaking, a fairly flat year, so to say, point to point, if we look at it. So have you been forced to make some changes on the equity, on the debt side, or on the commodity portfolio side?
So Niraj, I've always said that, I look for an asset class which is correcting or falling to get excited about investing my long-term money. Otherwise, in the middle, I don't like to act at all. In the middle, just let your funds and fund managers and the companies in which we invest take care of compounding. So, I was reasonably, let's say, underinvested in, global companies through global funds, whether in US or rest of the world. And the last 4 or 5 months gave an opportunity to start increasing exposure there because, we've seen a 20% sort of correction in some very marquee businesses and, great brands outside. And on the other hand, Indian markets have reasonably remained stronger. So while they've not made money, but they've held on. So I've increased my exposure to, global funds by, from around 7-8% all the way up to 16-17%. So that's one, big shift that I've made. And I want to reinforce what Radhika said that one reason why intermittently when debt and equity fluctuated so much while they ended the year doing nothing, we don't need to do much is because the dynamism of the asset allocation funds, they actually came to work in the last 12 months, where they rebalanced, very beautifully between both the asset classes, thus leaving us to focus more on our work and not worrying about whether we will invest at the right time or get out at the right time. So I think a big, it makes our investing life very boring when funds take away the mantle of doing formula-based investing.
Yeah, well. One is exciting, but may not earn as much returns as the boring part may. So, hey, let the boring continue. But which brings me to the question that I hate getting asked the most, and I'm guessing both of you too, but I still have to ask it. Market kya lagta hai? Kalpen, 12 months, no movement. What is your view on equities at large for the new Samvat?
आपके 3 शब्दों का जो सवाल था, मार्केट क्या लगता है, 4 शब्दों का जवाब 2 शब्दों में, मार्केट फ्लक्चुएट. But having said that, since I need to articulate a little bit more to sound more intelligent, I feel that interest rates generally, I have this very simplistic framework which does not work 25% of times, but it has worked for me 75% of time. It doesn't have too much of intelligence in it, but the framework is as follows: that in India, interest rates fluctuate between 6% to 9%, and long-term 10-year bond yields. Currently, we are in the middle at 7.5. So, we are closer to the long-term averages. But, there are tailwinds because of currency, because of deficits, because of, policymakers wanting to invest in growth, global uncertainty. Rates will start drifting higher. They've already drifted higher significantly, but they'll continue that drift for some more time. And that will make fixed income more, appealing. So 1 year back, when you parked money in fixed income by not being in equity, for example, we earned 3 and 4% return. But today, these portfolio yields have gone up to 7.5, closer to 7.75 also. So the parking lot is now more conducive for money. Though rates may still drift a little bit higher, but so fixed income becomes reasonably meaningful after a span of 2 or 3 years. On the other hand, while equity valuations are still on the higher side, I also know we are in that cycle right now where a lot of debates that valuations don't matter and something else matters. But last year has taught that eventually gravity comes back and common sense rules of principles come back. So thankfully there are many sectors of great companies which have corrected extensively in the last 6 months to 9 months. Tech stocks are down, healthcare stocks are down, banking stocks for the last 3-4 years have gone nowhere, whereas the credit cycle has just started to pick up. So somewhere equity is also in the middle. And hence, I think, some part of that froth of the market from both the asset classes has moved out. Global equity also, a lot of froth has, moved out, whether you look at, global tech companies or, Europe and Asia have been completely decimated. Emerging markets are like no longer talked about. 10 years back, they were like the shining star and the BRICS was the popular word. Today, no one talks about them. So there are pockets now which are emerging for one to start calibrating risk. And I feel, there are more opportunities opening up than there were 1 year back.
Okay, more opportunities opening up. Radhika, do you feel the same way about equities?
So I have 2 takes on this, and I really can't look at equities for even a 1 to 2 year horizon. But we have to answer market ka kya lagta hai, so I will answer market ka kya lagta hai. See, I think if you look at India, we feel that India's economy relative to the chaos in the rest of the world is better placed, at least from a 3-year point of view. I think if you look at core economic indicators today, if you look at some of the important drivers, whether it is private capex, whether it is some of the reforms-driven capex, there is a lot to be positive about, and even some of the things that are structurally challenging. For instance, inflation in India is a problem, but it's not an extent of problem compared to the US, where they haven't seen inflation like this in decades. So I think from a core Indian economy point of view, there are many reasons to be constructive over the next 2-3 years. And I think certainly from a fund point of view, there are many exciting themes. We are very excited about PLI and manufacturing driven stories. We are very excited about private capex. That all goes. That said, I don't think India's economy or markets will be isolated from the global turmoil that is ahead of us. So is it a glorious Samvat ahead? Is it all rosy? It's hard to say that. I think it will be a volatile 6 to 9 months, at least till we have certainty about how much interest rates rise ahead of us.
Yeah, and that's the difficult part. The last 2 or 3 Diwali conversations have had 1 or 2 lurking dangers, which have ceased to be dangers in 2 months' time, and something else comes up.
A new one comes up.
In a meaningful way, and that's been a. Sorry, Radhika, you want to make a point?
No, but the market has always been about unknowns.
Yeah.
Investing has never given you a perfect set of circumstances. Either the macro isn't perfect, or the valuations aren't perfect, or something else isn't perfect. And secondly, unknowns are the reason that there is alpha to be made.
Yep, most precisely. The other aspect is how a lot of people have been starting to make this point over the last couple of months that even if headline numbers or headline Nifty or the Sensex don't go anywhere, a bunch of broader market themes may do very well. And I know mid caps and small caps are too wide a bucket, especially small caps. But if I still were to ask you, Radhika, to bucket between large, mid, small, where would the larger weightage be within between the three market caps?
I think this is highly individual, Niraj.
So where would yours be?
Okay, so I tend to be a more conservative investor, but despite being a conservative investor, today, if I had to lean, I would probably be 60% large cap and 40% mid and small cap. In normal courses, I would probably be closer to 70-75% large cap. Today, my tilt, being a conservative investor, is mid and small cap biased. I do think that with the correction that we've seen, in particular pockets, very interesting stories are emerging on the mid and small cap side.
Okay, so it could be bottom up, but the large portion of the bottom up stories are at the broader end of the spectrum and not the large caps. All right, great. Thanks for that explanation, Radhika. Kalpen, what about you? The tilt.
Niraj, I don't believe in market cap based investing at all. My principle is invest in good companies and good prices, not driven by the lens of market cap. Yesterday, I was seeing an interview by this very amazing actor, Pankaj Tripathi, and he was asked this question, कि आप बहुत अच्छे character actor हो. And he felt offended. He said, मैं अच्छा actor हूँ. अब उसमें आप मुझे character actor, supporting actor के labels क्यों देते हो? So, the market cap based lens of investing is just more dissecting or granularizing the big principle investing of equity, which is buying good companies and not overpaying. So I have always built my personal portfolios around that dimension, and which is why most of my investments are in market cap agnostic funds or even country agnostic funds. So I choose funds which are based on rules, and the rules are only two: avoid ruin of bad companies and avoid ruin of overpaying. So any portfolio which follows these two principles, and because of that, if the underlying is 20% of small caps or 50% of large caps, so be it. So I just want to reinforce that message that the market cap lens sometimes is very challenging. And just one more thought that I have is that if you look back at the headlines in 2007, 8, 9, very similar narratives and stories were dominating in terms of all is too well. And small caps and mid caps have a lot of speed and energy, and they can make more money faster, and so on and so forth. So I've learned some of these lessons where whenever I've got trapped in the growth narrative, it has not made money for me. So I'm a bit more conservative from that lens, and hence don't think from a market cap perspective.
May I still ask you, Kalpen, the tilt of the funds that you're invested in, maybe market cap agnostic, but what is the tilt of those funds? Because a lot of stories may naturally be emerging, not necessarily in large caps, but at the broader end of the spectrum, since the market does bifurcate them into large, mid, small.
So, when I just intuitively think about it,
intuitively, yes,
in tilt will still be, let's say, 60 to 70% large cap, because like I said, 20% of my portfolio now is also global portfolio, and they end up being much bigger.
Large, yeah, that's true.
And the balance 25-30 will be mid cap. In fact, I still have 25% in fixed income. So if you take that out, the tilt will be 60 towards large cap and 40 towards mid and small.
That's maybe kind of coincides.
Yeah, I'm answering what Radhika said it in one line.
That's completely fine. It's lovely to hear elaborate explanations as well. Thankfully, we get time to do that on these shows. Therefore, you kind of part answered the next question that I wanted to ask you, Kalpen, which is, the relative change in allocation between equity and debt versus the previous one. So I heard you mention some numbers, but can you talk a bit about it relative to what was, say, last summer?
So in last 1 year, I think, October 2021 is when Indian markets hit its peak. And then since then till June 2021, in the next 9 months, they fell by 18%. So this was a period where my asset allocation funds, like every others, increased its tilt towards equity by around 20%. And I also added a little bit more to equity. So over the whole year, I would have moved around 7 to 8% from fixed income into equity. So if my fixed income was 30 to 33% last year, that has come down to around 25.
But I heard you also mention, Kalpen, that fixed income now becomes a real asset class to invest in. The TINA argument has gone away. So therefore, are you contemplating kind of moving a bit away from that reduced 25% to maybe a slightly higher number, or not really?
I'm not fine-tuning it as much, because like I said, that but I've seen interest rates at 9% also. Now I don't know whether we'll go there or not. We are still at 7.5%, and the journey from 7.5 to 8 can also be a bit painful from a return perspective. So what I'm doing right now, for every new money that I get from my salary, I'm investing in a 50-50 proportion. So and then there is a very fundamental thought behind it. When I look at the entire AUM of our fund industry, roughly 50 is in equity and 50 is in fixed income. And I myself as an investor, when I've tried to do my own 50 in equity separately, 50 in debt separately, and try to time it, I've realized my final returns are lower than even a passive fund. So it's better to invest in a structure which is always going to be 50-50. So in this phase, like I said, that fixed income has become more attractive than the past, but not the most attractive. Equity also has corrected relatively to the past, but still not very, very cheap. It is better to be somewhere in the middle, and let a structure take over. So I have a fund where I'm putting all my money, which doesn't have very attractive growth drivers, or it will not shoot the light out, but it will be a good parking lot for the next 2-3 years till a lot of these global uncertainties and interest rate reversals settle down, inflation settles down. So if stocks do well, my 50% portfolio will do well. If they don't do well, I will feel good that I have 50% in fixed income, which is defending. So that is the simplest approach. Now, this may lead to the same static asset allocation, because all new money is going in a 50-50.
Sure. Okay. So, but I'm guessing, Kalpen, sorry, just one last question there. I'm guessing that this is there is a category of such fund. Is this what is a balanced advantage fund, or what is it?
No. So this is a category called equity savings fund, where by mandate 40 rupees goes to stocks, 10 rupees goes to REITs and InvITs, which give you slightly higher carry. 15 rupees goes to arbitrage, and the balance 35 goes to fixed income. And we have enabled it to add around 10% into global stocks also. So it takes care of all the 4 broad asset classes that I like, but instead of me doing it, the fund does it on its own. And at higher valuations, the fund also has some bit of hedges in that. So it's a very tax efficient version of a proxy to a hedge fund. So it basically it's not a wealth creating idea, but it is a protection idea at this point in time.
Got it. Thanks, Kalpen. Thanks for that. Radhika, equity versus debt. It's a big argument right now. Where are you on it?
I'll give you my argument, and then I'll tell you why people shouldn't follow my argument, because my circumstances are a little bit unique. So I do my fixed income allocation through balanced advantage funds. I've been a big proponent of the category. So at any given point in time, 60-70% of my portfolio is a BAF. It's our own BAF. And so that broadly means that you vary between 40 to 60% equity would what I was last year, and that works. It's also very, very tax efficient, and I don't need to get through this. So on average, I was also probably 50% equity, because the BAF moved up and down last year, and I intend to be that way. I don't do standalone fixed income investing because I have a home loan, and for many people who have home loans, including many viewers, the debt math doesn't make sense. That said, for a lot of viewers and for a lot of people not in that situation, is this a better time to invest in fixed income, in my view, than it was last year? Definitely. I mean, the simple argument is that when do you want to book your FDs? When rates rise or when rates are low? So I think with a rising rate environment and where we are today, this is a better time than many a time to do long-term fixed income investments. And in fact, we are considering doing that for some of our portfolio, but I don't invest in fixed income standalone. I use BAFs, which work really well. But given the rise in, 1-year yields I was looking at a 1-year target maturity fund, that's 7%. I was looking at a 15-year target maturity fund, that's close to 8%. So not a bad time to look at fixed income in that sense.
Yeah, but I think there's a very nice, important point that Radhika has mentioned here, which is that because a lot of Indians have home loans, don't get into this whole habit, I think, of getting into fixed income products, which will give you slightly better return than the FD also, because the interest that you're paying on your home loan currently is anyways between 7.2, 7.3 to maybe 8% in certain cases. So I think it's a fairly important consideration.
I was looking at home loan rates. It's spiking well above the 8 handle, Niraj. So
it is? Okay.
most Indians, it's gone from 6.5% to 8.5%. So that's just something that you want to think about this year.
Yeah, very, very important. And by the way, viewers, none of the other narratives which people might say everywhere else that go into these kind of products are wrong. It's just that for a particular case of people who have a home loan, the things might be slightly different. Thank you, Radhika, for bringing that point. Now,
can I add about?
Of course, Kalpen, please do.
Because I finally bought a house last year, and this was in July and August when our markets were booming and everything looked very rosy. And there was huge temptation of taking a home loan and continuing with these investments. But long-term wisdom prevailed that if you want to sleep peacefully, avoid as much debt as possible. So I did not take a home loan and rather redeemed my investments from equity, little bit from fixed income, and bought the house. Now, in hindsight, it has given me much more easier nights, and it goes back to the first principle of personal finance that what returns markets will give, whether equity or fixed income, is going to be unknown. But what interest we have to pay is finite. So, the first rule is it is okay to redeem some of your money when, markets are rising or asset classes are peaking, and reduce some of your liabilities rather than being greedy about it. So I completely endorse what Radhika mentioned.
Yeah, journalists don't have too many assets. So I took a home loan because I didn't have assets to liquidate. As simple as that. But anyway,
debate that separately. I don't agree.
Yeah, that'll make for a very good debate.
We will do that some other time off air. Let's try and talk about the last 2 points. One, a really good product that the MF industry came up with. I know there are lots of rules and regulations, but I'm sure something came about, some tweak, some actual product. Radhika, can I start with you on this one?
Yeah, you guys are going to make fun of me, but I'm going to give the answer everyone expects to give. Though the product isn't this Samvat, it's an older product, but I really think target maturity fixed income funds found their mojo in this Samvat. I have never, back in 2019, Niraj, when we were having the first conversations around Bharat Bond, it was a struggle to convince people why you even needed the category. And cut to today, and I think these are being launched like kakras, no offense to kakras. But I really think that consumers have started to understand and discover that in a fixed income mutual fund, you can get a predictable, simple debt experience that is FD-like, where the quality of portfolio is good. And I don't know if people know, but today you have the MF industry offers fixed income solutions all the way from 2023 to 2037. That is a full yield curve of tax efficient, liquid, high quality fixed income investing at a cost of 10 to 15 basis points. I think that's pretty disruptive. It's a 1.2 lakh crore category today. I think it was half the size last year. And I could put money that this will be 2.5 lakh crore next year.
Yeah, and yes, no, we're not making fun of you, but yes, Radhika has been a big proponent of the target maturity category, and more so in the last couple of months, I've seen you speak at various forums about this, Radhika. So, no, not making fun of you. I'm glad you were kind of speaking it out loud and putting your mouth where your money might be, if I can use that term.
Absolutely.
Kalpen, what about you? What has stood out for you?
Let me make a confession. 2 years back when Radhika and we were on a panel, and there was a discussion about these target maturity funds and Bharat Bond, and I told Radhika, ये सब funds पहले भी available थे FMP format में, roll down format में, तो नया क्या है? But I think what really worked is the simplicity of it, and the fact that you're able to give different tenors to investors depending on their time horizons. 3 साल का FD replacement चाहिए, 6 साल का चाहिए, 5 साल का, 1 साल का, so that gets enabled. So not making fun, but inspired by you, we are launching many more, so that your 2.5 lakh target for the industry gets fulfilled. So that I think is a very, so I always tell her that these products were always there, but the way they have got positioned in the last 1 year really brought simplicity. And ultimately, the beauty of the fund industry is that it has everything that an investor can ask for. But it comes with a lot of its own jargons and complexity. So I think the whole concept of target maturity fund is a brilliant design. Started with what Edelweiss did, and then the rest of the industry has picked up. I feel another product that I personally like a lot, which respects first principles, is a fund which invests agnostic to countries or geography. So this is a fund where 70 rupees is in Indian companies, and 30 rupees goes to global companies. So you're basically buying good companies of the world, India and the world. And the 70-30 tilt is because it gives you tax efficiency of an equity fund. So it basically helps you in postponing tax for long. It helps you in participating in good Indian companies as well as global companies. And I feel that, the whole principle of diversification is respected here. So that's a personal favorite that I have. There are very few funds in the industry with this type of design, because what tends to happen is that when global stocks do very well, people like to invest only in global funds. Nothing wrong in that. You can do it independently. And when global stocks don't do very well, everyone would want to invest only in India. But a design like this allows you to constantly rebalance and keep adding what is going through a down cycle. And we've looked at history for last 10, 20, 25 years since the time data is available. This combination or blend reduces the volatility to some extent, but still gives you similar long-term return of equity as an asset class. So, we call it the DSP value fund. Fund houses like PPFS have been amongst the pioneers in bringing out an idea like this. So I personally like that category also quite a lot.
Okay. Well, the last question, and I must say, Radhika, you're on a show with two good Jews. You can't be kind of pointing towards khakras and say that that they are a routinely launched product. They are a lifeline.
I love khakras. I just think that I meant khakra in the best way, because I think Gujaratis are very creative with khakra. So you can have a Sichuan khakra, you can have a Jeera khakra, you can have any flavor of khakra that there is out there. I mean, it's ingenious and it's simple and it works. So I meant it before there's a controversy about me attacking khakras. I said it in the best possible way.
Yeah, but the purist will tell you that this is not the way the khakra should be, and which brings me to my last question. The one thing that you both of you think that you wish that the industry or the advisory community should not do, but is doing, and therefore there can be some course correction there. Difficult question maybe, but at times simple answers out there. For the longest time, the answer that I've heard is stop mis-selling dividend paying funds, because as fixed income fund, because they don't necessarily become that way. So for the longest time I've heard that answer. I wonder if this time is any different. Kalpen, can I start with you? One thing that the industry or the advisory committee should not do.
I'm glad you asked Kalpen first, because I was waiting to give a controversial answer and hoping I won't have to be first. So I'm very excited.
I would always say that what has to be stopped doing should start from me rather than anyone else, not the industry, not the advisors. It has to be what can I do, which is in my control. And I do feel that at times, in the quest of educating or informing our viewers or investors or advisors, we give a lot of continuous inputs, and these inputs actually create, they are like the WhatsApp notification which may want to make us act. And good investing is long-term investing. Good investing is notification free investing, so that you can let your money compound and get out of the way. What has happened over the last many years, with the advent of networks and social media and all of us getting a chance to express so much, in every meeting we may express 5 new ideas, and which leads to confusion in the minds of the consumer. So I want to just and this is something that we debate internally also, that where do we find the right balance between the right intent to educate, but at the same time not create an intent to unnecessarily act, because money after all is made with time. The longer the time horizon, the better the returns are. So I think in a nutshell, simplify the messaging. Keep messaging common to actionable principles, and messaging which allows you to enjoy a 15-hour flight, where only during takeoff and landing you have to do something. In between there is no need to do something. So only during market extremes come and give inputs towards rebalancing, but otherwise stay put.
Would it become difficult though, Kalpen? And as a mutual fund investor, I am asking this as well. Would it become difficult, because you would see a lot of your peers, even if you adopt this principle, you would see a lot of the peers continuously doing that, and at some point of time, the questions about recall value, etc., would come into play.
Niraj wants a controversial answer. That's
not at all. Not at all. In fact, I'm actually in a good way. As an investor, I see my inbox clogged with these notifications, so I can feel the pain also.
including so many that I keep sending. And see, I think we are all doing it with very good intent to say that now healthcare looks good, now banks look good, now interest rates look good. But what I also realize is that 95% of our investors don't have money every day to react to every new WhatsApp recommendation. So it's good that if they build a long-term portfolio of wealth creation through equities, little bit of fixed income to cushion volatility, and then apply their personal goals and time horizons. I think that is a bigger solution that will help, and I think with time we will all evolve and learn, because even if I look at my peers, the intent is to ensure that investors make money.
Of course. No, maybe since not everybody is so intuitively educated about finance, maybe these notifications help as well. As much as we think that they are a disturbance for people who are educated about finance, like me, I would like to believe that I am reasonably educated. Maybe for me it's a hindrance, but for a lot of people it's actually fairly educative. So yeah, maybe keep it up. Radhika, the same question to you. Waiting for the controversial answer.
I'm going to douse the controversy level since Kalpen totally disappointed. Look, I don't question intent, but I think we have lots of products out there, Niraj, and we keep launching more of them, khakra, samosa, whatever you want to call it. And I don't think the need of the hour, actually, if the MF industry stopped launching products today, I think we have everything it needs to serve a consumer. And I know people launch things for their own reasons, but I think less focus on product launches, especially at the top of the cycle, and more focus on educating people on how to use products. I think mutual fund products in some way are like Legos. All the building blocks are there. You now need to show people a vision of what you can do with these Lego pieces to solve real portfolio problems. Ultimately, no one, we have lovely debates on things like active and passive and all this stuff, but nobody wakes up in the morning thinking, today I'm going to go plan to invest in a passive fund. Today I'm going to try and generate 3% alpha over the benchmark. People are out there living their lives. Money is an enabler for goals and purposes. So I think shifting the conversation from products, launches, NFOs, to how to use these Legos to lead a very, very simple existence. I think a lot gets lost in the complexity of conversation, and I agree. I think it starts with all of us. So the big debate we have an internal product committee, which is where we take products before launching in them, and we probably reject 5 products for every 2 that we launch, because we keep asking ourselves this question: are we doing this to make ourselves happier, or are we solving a genuine consumer problem that has not been solved? And let's just go back to solving a genuine consumer problem.
Wow. Thanks both of you. This is, if not the finest, one of the finest mutual fund shows that I've done in a really long time. And I'm glad that I had both of you on such a joyous occasion to talk about a lot of things, some of which I've learned afresh and will try and imbibe when I do the mutual fund show over the course of the next 12 months. So to you, Kalpen, first, a very happy Diwali to you and yours. And thank you so much, as always, for joining us with your wisdom.
Thank you so much.
And Radhika, you got one of the possibly the greatest gift in the Samvat gone by, which is your little one. So have a great Diwali with the little one and your family. And thank you so much for joining with us today.
Thank you, and happy Diwali to all your viewers.
Thank you so much. And viewers, thanks for tuning in. To wish you all a very happy Diwali and a prosperous New Year.